Coming off the heels of the most highly anticipated Federal Reserve meeting in a number of years, both the stock and bond markets struggle to find a direction and a footing. Two classic signs of a recession continue to peek their head in a more intense level than they did last week. The Federal Reserve, we found out on Monday of this week that the pen is mightier than the sword. And I've got a great tip for my real estate agent friends that's going to save you a lot of time and heartache over the next few months. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. I hope you're having a great week. Well, it looks like the four horsemen, and a shout out to Ric Flair, have peeked their head, the four horsemen of the economy. I'm going to call them jobs, inflation, supply chain and logistics problems, and now the new one, geopolitics. When it comes to jobs, we definitely need more quality jobs, more careers for people, and we definitely want to see some wage inflation on the next jobs report to keep up with the real inflation that the consumer is dealing with every day. Inflation, on that note, if you take out food and energy, is not as bad as advertised. If we can get some of the other issues, which is the third horseman, supply chain, logistics, and shipping, taken care of, which I now believe are national security issues because of some obvious things we've seen lately. And the geopolitics, the fourth horseman, this is the great unknown that we're all dealing with right now. But those are indeed the four horsemen of the economy that the Federal Reserve is looking at right now. And you can almost call the Federal Reserve themselves the fifth horse of this calculation of the four horsemen. But we'll leave them off as they are going to take their cues from all of those other things. As I talked about, there are two classic signs of a recession showing their face right now. Number one, the inverted yield curve, or shortly there to be inverted, between the 2-year Treasury and the 10-year Treasury. The 5-year Treasury note did have a higher yield after the Federal Reserve meeting than the 10-year did, and that continues to be the case today. And once that 2 hits higher than the 5, which I believe right now it's at about a 20 basis point spread, that is a classic sign of a recession to come. And the second part of this, same as last week, oil prices. Every time there's a sharp rise like this, the consumer feels it and the consumer gets tired. And these oil prices, coupled with the inverted yield curve that's there in some cases and almost there in others, are signs of a classic recession to come. All right, on to the Federal Reserve. They are a very, very powerful organization that doesn't even need to raise rates to make rates go up. They can just talk about raising rates to make rates go up. So one thing here is the Federal Reserve, we all have to know, their number one tool that they have in their bag to help an economy out is to cut rates. So this might be one of those times where you have to raise rates to have the ability to cut rates. We will see what happens with that. As I mentioned, the Federal Reserve, the pen is mightier than the sword. So last week, they actually raised 25 basis points, which was pretty much in line with consensus. But then after that, they literally saw the yields on all the treasuries go down. They did not like that reaction. So on Monday of this week, the chairman of the Federal Reserve came out and said that they are not scared to do a 50 basis point rate hike when market conditions call for it at any of the meetings that they have upcoming, and that actually did the damage to the treasury markets that they wanted to happen last week when they actually raised. So in this case, the pen, which is the spoken word of the Federal Reserve, is actually mightier than the sword, which is the Federal Reserve actually raising rates on prime 0.25% last week. One thing the Federal Reserve, I think, for all of their greatness, on this balancing act that they have to do with the U.S. economy and the global economy at this point, I do think they're fighting inflation in the wrong way right now. I believe that the majority of inflation, daily inflation, not one-time purchases of a washer or dryer or a car or one of the other things I keep talking about. People need those, but they're not buying new washers and dryers every day. It's the everyday inflation in the food, gas, oil, energy, basic daily living things that the consumer's dealing with. And I don't know if the Federal Reserve is fighting this inflation the right way. I don't know if there's actually something in their toolbox to fight this inflation, because they go a lot more macro typically than to hone in on a sector or two. But it might be time to hone in on trying to curb the inflation, food and energy related, because that is going to help the consumer out. As we know, the U.S. economy, 70% of it is based on consumer spending. The consumer is getting squeezed on a daily basis with the things they buy, and I think the Federal Reserve may have squeezed the consumer too hard now in terms of those one-time purchases that they might have to make when coupled with the daily purchases that they have to make. And as I mentioned, they may have put us into a recession just by what they said here on Monday. I do have an idea, though, and this is not a new idea. I mentioned it last week, and it came to my mind again today. I saw on TV today that there's a lot of semiconductor chip makers on Capitol Hill clamoring for Congress, Senate, whoever they're talking to subsidize some of their supplies and things like that. I find it very odd that these are multi-billion, and if you add them all together, few trillion dollar organizations that are very powerful and can basically, print money by borrowing it at these very cheap rates. That they're actually going to the government for subsidies. I essentially find that appalling. It's like corporate welfare to me, because I don't know any other industry that can get together and go to Washington and basically ask for money. The last time I remember this happening was back in 2008 and 9, the Great Recession. A big car company actually flew private to Washington, D.C. to beg for money. And the lawmakers laughed them out when they asked them how they got there. They said they took a private jet. Well, a few months later, as a dog and pony show, they all drove from Detroit to Washington, D.C. in hybrid vehicles. If I was Congress or the Senate, I would have been more appalled at that than them showing up on a private plane. Nonetheless, corporate welfare is a real thing. I find it appalling that corporations right now are going to Congress and Senate and whoever in Washington asking them for money. Why don't we have the same people that are using those lobbyists come to the U.S. consumer again and help subsidize gas prices right at the pump and grocery prices right at checkout? Because I guarantee you that's going to be less money than it's going to add up to with these corporations, trillion-dollar entities with their handout going on welfare. It's an insane thing to me. It's really not capitalism. It's like American capitalism, maybe you can call it, as we've maybe started this in the last 15 years, a new kind of capitalism, which includes corporate welfare. We will see what happens, but I believe somebody has to step up and protect the consumer every day from food and gas prices. All right, so the quick shock here that the housing market is feeling. I know a lot of my real estate friends and agents and colleagues and coworkers don't like it and didn't like it last week when I said that the mortgage market was flashing yellow for the housing market. But if I said anything else, it wouldn't make sense to me. And actually, those words couldn't come out of my mouth. There's no way that the consumer is not going to have a shock when they are looking to buy a house now as opposed to 4 months ago when it comes to their monthly obligation and affordability. So, mortgage rates at this level that they've gone up to, they are flashing yellow, a little bit darker than last week. They are going to start hindering affordability. Now, that said, we have a very big constraint on housing supply right now. That in and of itself, and the cost of building a new house, acquiring, and even finding the labor to do that is going to be very much supportive of the current houses that are actually built, of supporting their values. I believe current housing values are safe. I just don't think they're going to appreciate at the rate they have been appreciating. And here is a tip to my realtor friends. Do yourself and your clients a big favor. Get your pre-approvals updated to reflect today's interest rates, because some of our clients, as we all know, are right on the edge of affordability. And this recent rise in rates to the tune of 1% in some cases from interest rates a few months back will take some pre-approvals out of the realm of being able to be funded and closed. So definitely, as a real estate agent, you want to get updated pre-approvals. And as we look at everything in the economy as a whole, I think a simplistic way to look at this, there's been a big party, a lot of money being passed out, And now, just like a Rick James party that went a little too long, there might be a little bit of an economic hangover and a little bit of a hangover in the housing market, but the party will start once again when the Federal Reserve starts cutting rates. I know it's a weird thing for me to say and probably weirder for you to hear, but when they start cutting rates again, when they realize they attacked inflation with the wrong tools and in the wrong direction, these rates will come down. All right, everybody, that is my